I'll take the first thumbs up out of the community comments that we've been engaging on for the last, I guess, 20 minutes or so. I just enjoy the heck out of it. If you guys are getting good audio coming through, please give me a thumbs up. Please let me know that this is coming through fine. Great. Thank you. Appreciate that. Guys, we've been putting out just a ton of content, especially over the last year. And it's great because I get reciprocation when I put the information out there. And what that means is I get hit with a ton of people's, questions on portfolio building. That's really the nuts and bolts of why we're doing this. You guys know that I spend a ton of time talking about the fundamental aspect, all the things that build up to preparing someone to enter into the stock market that's never had any experience or doesn't quite have an idea about their risk tolerance. So I came out with this Sunday live feed to really focus in on Portfolio Building 101. And I allude to portfolio building all the time as really being, I get energy when I think about portfolio building. That's how much of a dork and a geek I am about this stuff. But when it comes to other people, I'm very, very aggressive about making sure that the message is coming across crystal clear. This isn't an emergency live stream. This is really just a treat for me to come on and offer this as a bridge for folks that are looking to get involved with the stock market. We had one comment. I've got Silver Helm in the group here who's rocking out a first funding and joining this particular group to understand how it is that you can deploy that in the stock market strategically. All right. And I'm going to give this my all. All right. I'm going to deploy. I've got Ernest and I've got Jared in the group here. Certainly. These guys are ambassadors in the Facebook group. I trust them indefinitely with their recommendations. Certainly, if you have questions, I would expect if Ernest is going to sit back and enjoy himself this evening, and Jared Odell as well, welcome to you. I always acknowledge those guys when they come in here because I'm going to tell you one thing, and I hope this resonates with you guys. I can't do this myself, all right? I'm winning the battle from a leadership perspective if I can empower and facilitate discussion. And you might not hear something from me that makes sense. You may hear something with somebody else that's part of the community, and that is the beauty of it. I am a firm believer in getting results greater than yourself, okay? It doesn't matter if I say the perfect thing. It doesn't matter if I make all 10,000 subscribers to the YouTube channel, Independent Investor channel, happy. We will end up at a better place knowing that you are excited about being part of a group that is all moving to something special, all right? Now, before we get started on portfolio building, what I mean by that, if there's any misconception at all, if you're new to the channel, you guys are all winners, all right? Self-directed investing, if it's being introduced to you for the first time, I would invite you to go back and catch some of my catalog, if not all of them, to get that explanation, because make no mistake, that is the crystal clear message of building a portfolio in an account that's going to receive it. And I get comments all the time. I joined Stash. Is this right? I joined Robinhood. Is this the right approach? I invested in this stock. And people are just hitting these roadblocks. And they're doing so after purchasing an asset and not doing their homework ahead of time. Now, eventually, I want to move everyone from understanding that it's much braver to be a non-investor than it is to actually enter some exposure to the stock market. All right. So eventually you've kind of got to get over your, whatever preconceived idea you have about the stock market. And I'm not saying those are wrong. All right. Have them. They're natural emotions to the stock market. If you've had friends out there that have lost money in the stock market, don't ignore those. Acknowledge them. Okay. But there's probably some level of lack of preparation. There's probably some mistakes that were made. There was probably some irrational decision making. There was probably some poor financial planning. There was probably some mismanagement that facilitated that. And typically when people hear about negatives in the stock market, they're typically hearing about just the tip of the iceberg, or somebody wants to say, you know what, it didn't work for me, therefore it cannot work for you. All right. And I'm here to blow that stuff out of the water. And as a self-directed investor, you have such a wide playing field in that we've almost eliminated all of the fees. That 0.04 to 0.10 of expense that I throw out all the time, you guys don't understand how low of an expense arena that is. And that's an arena that I don't mind playing in, insofar as I don't even mind recommending that we look at fine products like the VTI and the VOO and some of the spider ETFs that I've thrown out there. Now, I came out with my gaps and overlaps video, and it was received very, very well. But you guys have to understand, I'm going to start to get a little bit more cutting edge on my message. Why do I have to do that? Because nobody else is talking about it on YouTube. And it's very, very important that you not only acknowledge where you are, but where you need to go. All right. So if you guys have already started portfolios out there, I congratulate you. If you've fallen into some of these assets like a VTI and a VOO, and you've got them in the same portfolio, and I say something this evening to let you know that you might have a little bit of overlap in your account, so be it. It's not the end of the world. It's very, very simple to hit the sell button and go ahead and re-rack. Those are some small learning curves or small mistakes that I can accept. All right. But don't beat yourself up over it, all right? You cannot get involved with the stock market and be immune to mistakes in the stock market, all right? So I am going to try my best to engage with the group, but I am going to be laser focused on getting you guys the 101, all right? If you're sitting there and you need some explanation on what are the critical steps in entering into the stock market and getting your portfolio built, and that's going to be the last item that we talk about, is going to be the build, all right? The build is going to be what you're going to want to stick around for, and I'm going to give you my very, very best effort. But here's the thing, guys. Before we get to the build, you have to understand, and I've used this before, what your exposure is going to be. Greg, thank you so much, man. I appreciate the call out, man. It's nice to see you in the group here. But I've used this to demonstrate to you guys, and this is one of the biggest things that I see go awry in a lot of people's portfolio, is that they save up that first $1,000, they throw it all at the stock market, all right? So instead of picking an exposure bubble that makes sense for them, all right, they overexpose to the stock market, all right? And I'm not sure what the why this happens so often. You really just need to take a step back and say, you know what, I've put this $1,000 aside. In watching the Independent Investor channel, I've learned a few things about what Ryan's talking about as far as we've been on a 10-year bull market, all right? There's volatility baked into the stock market right now. Now, we don't know where the stock market is going to go, but it is fair to acknowledge where the stock market has been and where it is currently, all right? Now, that right there can help play into your decision of saying, you know what, Ryan's talking about the stock market. A lot of people are talking about this market being in later innings. Maybe I need to expose a little bit less rather than take that $1,000, and it's the only savings that I have, all right? We're not going to talk about budget, and we're not going to talk about savings. I've talked about that on prior videos. So this video with regard to Portfolio Building 101 is assuming that you've gone through those exercises. And guys, as we grow with the community, there's always going to be folks that filter in and need this reassessment or reevaluation of where they are with their budget and where they are with their savings, right? In assessing their own personal not only aptitude, but capability to enter the stock market, all right? This is assuming tonight that we have went through those checks and balances and that we've identified, let's say, $25 out of our budget that we can put into this plan that we're eventually going to build out, all right? But you guys have to understand that With the current stock market right now, let me throw some examples at you. I'll use the $1,000 example again. It would not be so out of the picture or realm of possibility for you to come back and say, you know what, I just want to buy 2 shares of VTI and put the rest of cash on the side. I'm going to expose, let's say, 50% of my total overall investing cash. Now, I know that seems a little bit light, but I always look at money as a relative topic, all right? With mathematics, I can always make something make sense, whether or not you have $1,000, whether or not you have $10,000. It's all about picking your exposure to the stock market. This is so critical, all right? And if you came to me and you said, you know what, I've got $10,000 to invest, I just want to do 1% to the stock market. I just want to do $10. You know, we could look at those as a starting point and say, you know what, if you've got $10,000 and you want to take $2,500 and put it into the stock market, that right there buys you 10 shares of the VOO. Now you're identifying your starting place at 25% exposure to the stock market. All right. So this is just critical. And all this does really is give you a baseline. Now, remember what I said at the top of the live stream. You're all winners, okay? I'm not going to apologize for putting you guys on a self-directed program, because the total overall potential that you're putting your money on, the track that you're putting it on, especially you guys that are young, 20s and 30s, and you're just finding your way to self-directed investing. Remember the equation, the 3%, and how it affects your money over time. We scrub that 3%. So when we pursue that 7, 8, or 9% rate of return in the stock market, I just released the rule of 72, and that's the range that I'm looking at, 7, 8, maybe 9% within that range rate of return. It doesn't do me any good to sit here and talk about going in and putting a bunch of mutual funds in a managed account. Over time, you're not going to realize that 7, 8, or 9%. It's going to be more like 5 or 6%, all right? And that extra couple percent right there, industry average is 3%, is going to make all the difference over time, all right? So back to this exposure limit. If you were ever going to sit back and be defensive and say, you know what, I have some reservation about the stock market, you know, I work really hard for my money, I'm not sitting on a bunch of cash, you know, this is my hard-earned money. And you say, Ryan, you know, what is a good diversified base for me? What should I do? All right. And I can't answer that for you. What I can do is define a landscape from 1% to 100% exposure. All right. And I just explained to you that a lot of error comes in saving up that first $5,000 and just dumping the whole thing on the stock market. Now, if you're young, that can work. All right. If you're in your early 20s and you've got that $5,000 and you're comfortable with that and say, Ryan, I'm good with the exposure limit. I'm good. Let's move on with the conversation. All right. But you have to understand and acknowledge, if you were just to sit back and say, what is the current state of the US stock market right now? What is the current state of the geopolitical risk on the landscape? And that's a big deal. There's more talk right now of this effect on China being much more impactful on our market than what's being led on. All right. So the volatility has spiked up. Is this a stock market that you just want to throw all your eggs in? All right. I wouldn't do it for me. So I'm sure as heck not going to recommend it for you guys if you're new investors and you're looking to get involved in the stock market right now. Now, the best time to get involved in the stock market is yesterday. Okay? So we don't try to time the stock market. I'm not going to get on here and tell you that doom and gloom is going to come in 2019. All right? Anybody that's doing that is trying to sell propaganda and tell you something that you potentially want to hear, because that's really what audiences want to hear. And Jesus, you're tuning into YouTube to try to find out this information. You know what I mean? All right. So the exposure limit is the key here, man. And it very well may make sense to take that if you've got $10,000 to invest, right? The maximum cap for 2018 is going to be $5,500. It starts again here in 2019 at $6,000 next year, all right? So when we start to get up to amounts that are pushing up against those maximum caps per year, that's one of those things that you got to kind of acknowledge. So if you're one of those investors that has $1,000 to invest, go ahead and put that in there, but you're going to have to define what level of exposure you are willing to seek out in the stock market. Now, again, the younger that you are, the more risk that you should be able to take on. But I'm not going to sit here and tell you that you have to take that entire $1,000 and dump it on the stock market. Dave, good evening to you. It's nice to see you pop in the group here. I'm doing the first block on exposure protocol to the stock market. This gets overlooked all the time. And when people end up looking back and looking at their decision and saying, man, I took $5,000 and dumped it on this stock market, it sometimes gets misconstrued as a mistake. And I always say, why didn't you just look at it and devote 50%? Why didn't you define, your entry point here, right? Instead of just taking your entire amount and dumping your exposure into the stock market. My question is, how much idle cash do you have on the side? And typically they come back and say, Ryan, I don't have very much. I might have, $100 in my savings account. And it's like, I saved for years to invest. I want to invest. But the term that I use all the time, and I hope this is something that at least if I teach one person in the group tonight, when I refer to using scale, this is exactly what I'm talking about. Using scale to enter into the stock market. And you may shoot here to start at 25% exposure in the stock market. You may have that $1,000 and you may start with 250. You might buy one share of VOO and that's your step into the market. All right. But it doesn't mean that you can't invest more in the future. Okay. But you can't overexpose to the stock market and then second guess your opinion with regard to your misallocation of this exposure protocol that you have for yourself. It doesn't work that way. And I've been working on some portfolio building for some folks in the community this week. And I always put it to them this way. All right. I'm always like, when you go from zero to a non-investor to an investor in the stock market, and you're looking to step a starting position into the stock market, I want you guys to visualize a year down the line when you're looking at the decision that you made to enter the stock market now. Now, in the example that I buy one share of VOO, all right, I buy one share of the S&P 500. When next year rolls around, think about how much information you're going to have by evaluating that one share of VOO over that entire 365-day process. You're going to either be up or you're going to be down, all right? Now, you're basically going to be giving yourself the decision to either add more, okay, or branch out and identify those gaps and start working on those gaps that I talk about in the portfolio. That's where it starts to get into the build here, all right? But think about this. Think about setting your portfolio up for future decisions. And the error that I want to take out of portfolio building is making counterproductive decisions. And I know Mike O has been gracious enough to offer up a comment in the community here saying, Ryan, you're right. I was a little bit more overexposed than I needed to be to the stock market. I was a little bit too watered down. I wanted to buy everything under the sun. I had another comment come through the group just today that said, Ryan, you came out with your videos on gaps and overlaps. Do I need to add VTI? Do I need to add anything with VTI in my portfolio? The answer is no. VTI covers the entire US stock market, all right? The S&P 500 covers 81% of the large cap US stock market. The other 19% is covered by companies that have a market cap of over $1 billion of market capitalization. That's the other 19%. So you can't capture the entire US stock market by just buying VOO. You're going to need a little bit of help. That's a gap in the portfolio. That's fine. It's fine. The portfolio is not going to fall off a cliff by owning the S&P 500, but it's a beautiful step into the stock market for a lot of people. If you want to just buy it all, you can buy the VTI, right? And those products put together, much more diversified in the VTI, perform at about a 7 to 8% clip over time. And the question was, do I need to buy anything else with the VTI? And again, with the gaps and overlaps perspective, I look at a portfolio with just VTI and say, your US stock market is covered. You're good, all right? But is there room to add to it? Is there international stock portfolio addition that I can make? Or is there some fixed equity that I can add to that portfolio? All right, we'll get to that. All right, but this is extremely, extremely important. And you guys that are new investors, don't overestimate your capability. Don't underestimate it as well, all right? There's going to be a lot of tough investors that come in here. You know, male, female, doesn't even matter. That's why I said there's no stereotyping in investing. It's not. I mean, you can be the biggest, baddest street fighter and be a horrible investor, all right? You can be a savvy business lady and just kill it in investing. It's all about your mental makeup. It is. It's all about your mental makeup. But this is a misstep all the time, to where sometimes that ego gets ahead of you and you just want to jump into the stock market and say, I got this, when in fact it's a lot harder to watch your portfolio adjust back when the volatility spikes, all right? So that is exposure in a nutshell. And this is the very, very first step, very, very important, to identify your exposure limit when compared to your overall. The circle, the green circle, is indicative of your investable cash, all right? This is aside from your savings account or your rainy day fund, okay? Your 6 months of buildup. For you guys that watch Dave Ramsey, all right? That's really the only piece that I resonate with, other than the fact that I think you should have much more in excess of 6 months of cash built up in your savings account. All right, that can be an identified gap. There's infinite amount of improvement that you can have for your investable cash on the sideline. All right, so guys, I'm going to check out the. I've got live chat on here now. I'm going to go ahead and scroll up here and make sure that there's no driving questions here. If you didn't catch the rule of 72, we're going to get on to the next account and to the build next. But if there's any questions at all with regard to your exposure, please hit me up. If this doesn't make sense to you, please let me know. All right, but I'm going to scan through here real quick. I've just got a ton of people in the group tonight, and thank you so much for tuning in. This was a very, very important message, and we will build the message over time with the community. All right, there's no right or wrong answer when you're investing. There are just general guidelines, and I'm not one of those folks that come out. This is the downfall of how to invest $1,000 videos, is because people come out and they say, buy an ETF, all right? That might fit somebody, it might not, all right? They say, buy 2 stocks. That may fit, it may not. Chances are the majority of people who are consuming that content, it's not going to fit in respect to their entire portfolio makeup. And that's the danger of putting out that information. Now, I've put out how to invest $1,000 videos, all right? And I've evolved in my thought in understanding what it is that's truly, truly important for a new investor out there, saying, what's important, Ryan? In one word to start, it's exposure, all right? So you have to make sure that you're identifying your level of exposure before we enter into and start the portfolio building steps. All right. Let me kind of cruise through here and make sure that there's no comments that jump down. Mike, I appreciate you offering your numbers in the group here, man. It's very nice that you did this. I just did the math and I'm only 15% exposed to the market right now. That's interesting. It's 15% is just, you know, I mean, you're right here. You know, that's just what's represented. So it's a start to define, you know, how much exposure you actually have to the stock market. I just spoke with a subscriber to the community earlier tonight about this as well. And they were kind of a victim of trying to time the market. You know, they're looking at the stock market and they're saying it's at an all-time high. I've got to pull everything out and I've got to buy at a lower price. All right. And this live stream is not about that this evening, all right? But I will just offer this. Timing the market typically makes, it usually ends up in failure, all right? So I understand the temptation behind trying to time the market, all right? And I'm not talking about opportunistic buying, all right? I'm not talking about acknowledging the stock market down 10%. I'm looking to pick up some stock because the indicator has shown you that the stock market is 10% off of its high, right? So it makes perfect sense to me to go ahead and use that as an opportunity to buy the dip, okay? You can do that, all right? But all too often I find that people are pulling their entire portfolio out of the stock market and sitting there waiting. You will end up indefinitely failing on that. Try me if you'd like, but it's my duty to provide you guys the truth with regard to how difficult or how impossible it is to actually time the market. But that's really where your cash on the sideline comes in when the stock market does end up, in fact, taking a dip, and you're looking to, kind of take advantage of that. I've talked about the strategic buying that I've done over the last 25 years. When the stock market is red, that's when I buy. I never buy on a green day. Never. Never. Why? Why? Buy when you're given that opportunity to buy, all right? And that can kind of help when you're talking about the build as well, especially when you're talking, we had a buying opportunity last week with down 500. If you're going to get an opportunity to enter the stock market, do it on a red day. That's not timing the market. There's a difference, all right? Becky, good evening to you, Big A. Tim, nice to see you guys again. Jared, this is definitely something I need to better improve my portfolio. So Happel R, that's an interesting comment that you made there. And it's always about identifying what it is that you, excuse me, what you need to improve upon when you're looking to build a portfolio. Because listen, the chances are I'll get on here and talk for a 2-hour live feed about Portfolio Building 101. There's probably going to be something that you miss, and that's okay. It's okay. All right. I'm not setting you guys up for, I always put that safety net underneath of you to where if you guys trip and fall and end up buying too much VTI, I'm cool with that, right? If you guys trip and fall and end up in one of the brokerage houses that I recommend, I'm okay with that, all right? What I'm not okay with is you tripping and falling into stash, okay? I'm not cool with that. I'm not excited about you guys tripping and falling and ending up in Robinhood, all right? There's a certain order of operations, and I define that safety net very, very clearly to where when we're talking about the build, I set a playing field to put you guys in a playing field to where, look, you're going to end up picking the exposure that you want to the stock market. And let's be real, guys. There's 3 different exposure protocols to the stock market. Let's be real. All right. If you go into a financial planner and they tell you that they have 2,000 mutual funds to pick from, it means squat to me, and it shouldn't mean squat to you. It doesn't. All right. Because I can speak about holistic financial planning and portfolio building without ever mentioning mutual funds. Okay. Mutual funds are way too high a cost, and unfortunately, they carry with it a side agenda for a financial planner when you go and sit down with them. So they're looking to sell you on, 1 or 2 or maybe as much as 5 of those mutual funds that they receive a kickback for. Why do that? Why do that when you have passive index funds, passive ETFs on the market, and good old single stock? You have that capability to just buy those 3 options right there. The other one being fixed equities as well. And fixed equities is going to be something that we talk about when we get in here to the build respective to your age. All right. So we're going to use the fixed equity option as a buffer in your portfolio, depending on how old you are. All right. So it's very cool stuff. Everybody says, so thank you for that comment. That's a good one. Appreciate it. This, I think, is a great resource. Jerry Welch has got a link there. I assume that's probably a portfolio building link. I've checked the one that Ernest dropped in the Facebook group. I'm quite certain that's a good one. I have a very good one within my brokerage house, as I believe you guys probably do. I'm with Merrill Edge, and the asset allocator tool will walk you through this very exercise. It is absolutely fantastic for you guys that want to know your sector exposure. All right, I did a sector exposure video or a sector allocation where I talked about the 19% in technology, the 15% in financials, the 15% in healthcare, whatever it was, right? You're going to get those through the reports function on your brokerage house. If you have just nothing but like a total stock market index, you're going to be able to run a report on that. Let's say you just hold VTI. It's still going to split that out and tell you what in that ETF you're exposed to. It's just very, very beautiful to understand your exposure protocols. Let me get to some of these questions here. What do you think about VFH with the financials getting slammed this year? I don't own the financials. I don't own VFH. I grab my financials through single stock allocation. That's just what I choose to do. And this is going to be part of what I explain when I work through the build portion of the portfolio. It's a good question. They are getting slammed on right now. But you guys know I dropped on the live feed on Friday that I did pick up some Morgan Stanley. I already own Citigroup. I may be buying Wells Fargo back. I own JP Morgan Chase. And then I would buy Bank of America as well. American Tower REIT is a financial services. But it's also kind of a real estate REIT as well, but it's actually listed as a financial services company. So that's another one. I do have AIG, which is an insurer. That's interesting. So I do seek that exposure, not by the financial sector SPDR ETF, but through single stock investing. I appreciate that question. Let me try to get, I hope J&J sells off on Monday. I'm going to buy more. I already bought more. It's a great single stock. How are these things such as VTI and VOO taxed when we buy these things and become a main part of our portfolio? So Happy R, remember how I talked to you guys about you being winners, right, to start? You guys buy these in your Roth IRA, all right? Now, if you're going to buy it outside of your Roth IRA, let's say it's going to go into a taxable joint account or a taxable brokerage account, you can do that, all right? It's just that once they become long-term capital gains tax, if you withdraw that, they'll be withdrawn as long-term capital gains. And depending on what your income bracket is, will depend on the level of earned income that you'll have to pay on those. But what we're talking about here tonight is that primary option. And for most people are working in that range of $0 to $6,000 per year, all right, which puts you right into the Roth IRA, all right? So if you're in the Roth IRA, we need to funnel these, whatever funding that you've got here, whatever exposure rate into the Roth IRA that you've got, and start to park some of these assets within your portfolio in your Roth IRA. Now, that question also speaks to, you're not going to be able to buy the entire stock market, let's say in the first year, okay? You may end up stepping into VOO, which is the S&P 500, for the first couple years, or maybe even just the first year. But remember what I talked about, putting yourself in a decision down the line to reflect back on and say, wow, I'm really glad I did that. I started with VOO. Let's say it's down 10% next year, whatever, all right? Let's say you have that money allocated again for the New Year's contributions and you want to pick up a few more shares of VOO, but you also want to add a single stock, or maybe you want to add VB, which is the small cap index. Remember I talked about VOO being only 81% of the total of the US stock market. The VB is going to be your small cap exposure. So maybe you want to start a small allocation to the VB within your portfolio. You're putting yourself in a position to make decisions down the line based on the good decisions that you make now, all right? And the mistakes that are made is when you get overexposed or you make a wrong decision or somebody tells you something that sounds really good and you jump into it and you end up using the following year to not add to but to fix that decision that you make. I see it all the time. It's tough. It really is. And that's why I'd rather see you scale into the stock market rather than just jump in with both feet here and start to put lump sums at the stock market. All right. That's a good question. I really appreciate that. When we get to the build of the portfolio, you'll understand that the VOO, the way I invest passively in my retirement sponsored account, is I own 70% of the VOO. I own 20% of the other 19%, the small cap index, and then the remaining I own for international exposure. All right. So you talk about the follow-on year. Maybe we add VOO, maybe we add VB, maybe the follow-on year, maybe we add some international stock exposure to the portfolio, right? And we let those grow. Guys, life is long and life is good. All right. You're going to have multiple decisions to make throughout the year in and year out when we start these portfolios up, right? And you want to continue to put yourself in a position to make decisions that are predicated upon the previous year's decision. Very, very important to understand that. That's a very, very good question. Thank you. Putting a Roth non-taxed otherwise. Thank you, Proper. That's correct. I just want to scroll down through here, guys, and get to some of this. Again, Average Joe, thanks for popping in the group here, man. Appreciate it, Dave. If I don't get to tell you Merry Christmas to you, I hope you and the family are doing well. Newly married from what I can remember. So I think he was married this year. So very cool stuff, man. Nice to see you in here, Dave. Avi A, Sunday night portfolio building party. Yeah. So the portfolio building, just super, super fun. I want you guys to have fun with this stuff, man. If you think for a second that you've got your reservations about entering the stock market, just remember these products that we talk about. I call the Vanguard's website, the ETF website. They've got 43 ETFs on there. You could look nowhere else but that particular marketplace of products to build your portfolio, all right? To enter in and start executing this build. All right. I also want to premise this. So many people want to talk about just this right here, the build on YouTube, and not talk at all about any of this stuff, any of the psychological, why we're doing what we're doing. And I really feel like that's a big, big disservice for folks, man. So there's a reason why we do this explanation before we jump into the build portion of it. But there is an absolute reason we want to prepare you mentally, man. I'm not doing a service. I'm actually doing a disservice if I don't explain it in that manner and you guys go out there and you misconstrue or misapply the information and kind of get yourself into a spot. Because like I said, man, the stock market is the big leagues. It really is. It's a very humbling place. And you've got to approach it with care. You have to do certain things fundamentally that may not make mental sense or may not make a heartfelt sense. You may just want to go out there and put $10,000 on Facebook because a YouTube guy told you that, or a gal told you that that's what you had to do. But it may not make sense why, if you're 50 years old out there and you're looking to portfolio build, that you need to add some fixed equities position within your portfolio. It's just one of those fundamental things that really, it goes along with sound strategy when you're building portfolio. And those are the things we look to exploit, to provide options to people, and they can kind of choose how they want to adjust their pie and get those portfolios built out to work for you guys and actually be defensive in nature so they can withstand a downturn. If this volatility continues, I know Ernest had thrown something in there that we're at a 10% correction right now. And typically they'll run through at about a 20% correction. All right. So you have to imagine, is your portfolio strong enough to take you into a downturn, right? And not drive you out of the stock market in fear, you know, which is the last thing that you ever want to do. Let me get to some of these questions here. How does everyone feel in regards to the emerging and developed market ETF? Coming into 2019, I think it's an imperative part of the portfolio. I don't think it needs to be a flagship portion of the portfolio. If you don't have, I would put international exposure in there on the large cap side first, before I would look at developing markets. If you were interested in adding a little bit of risk to your portfolio, go ahead and set yourself up at a limit. And it just 5 to 10% is what's coming to my mind. If you want to go ahead and invest in the EEM, you can do that, all right? But just make sure that you're exercising relative scale, and don't go with the emerging markets in your portfolio as a holistic piece to your risk. I think you're going to find that that's probably planned failure. I think starting with the US market, and I don't mean to be partial, but the US stock market is where you want to be. It is, all right? So that really needs to be the governing or the flagship portion of your total overall portfolio when you're looking to build this thing out. So I wish I had been smart enough to have invested more in my early 20s. Yeah, Greg, you're with me on that one. I wish I had access to some of these products. I know myself and Ernest have had discussion offline with regard to how the investing landscape have changed. I just can't believe that I can offer solutions to you guys. And I know some of you guys are very happy with M1. Some of you guys are going with First Trade, which to have that opportunity to get on there and enter into some of these positions and gain your exposure to the stock market basically free of charge is something that up till about 10 years ago, I didn't even have access to. And I just think it's an awesome thing. And we're so glad to deliver those solutions to you guys. Really are. I've got K97 here, right? If I create another pie or account, for example, in my M1 for my kids and my kids' name, will that hurt them in terms of getting scholarships aid if it is in their name instead of being in mine? Probably. Yeah, probably will. They take into consider, they do a pretty hard look on that stuff. You know, one thing that you could look into is the UGMA. If you Google UGMA, it's the Uniform Gift to Minors Act. That might be a better way to go because you're basically gifting that money to them when they reach the vesting age, which could be either 18 or 21 years old, depending on the state that you live in. All right, so just be kind of cautious of that. No matter how big that money is, if it grows to 20, 30, 40, 50 grand, they're going to get that money. They're legally entitled to it. So I would absolutely run that question by a tax accountant if you were really honestly concerned with that. I'd like to see my kids go to community college before they end up going to a four-year university right out the gate. Try to get an idea of what they want to do and focus in on their degree before they enter into, you know, a four-year university that they've got scholarships to. That's what I did, and I wish I would have done it differently. I really do. That's a good question. So that's really it with the exposure. The next thing is just a very, very quick re-emphasis of what's important with regard to the account. All right. So that is the exposure lesson. So if you're a new investor and you're looking to get involved in the stock market, always define your level of exposure here. All right. Now, the next solution that we offer is the account. All right. The account cannot be overstated. And I know there's a ton of people out there talking about the 3% that you get in Robinhood. All right. The problem is, and the double-sided coin to Robinhood is that, are you going to park $10,000 in the account to earn $300 and not invest that money? That's assuming that you're going to make that 3% over a 365-day period, and that you're going to take that 3% in and not take advantage of their trading platform. That's really what they are. You know, you're getting most of the benefit from Robinhood, you know, by trading in and out of stock. And it's something that I don't advocate for, because those typically end up being, you know, 200 or 300 short-term trades. And if you think I'm kidding, I have people that come to me all the time and they're like, Ryan, I saw your video on Robinhood, and you were right. You were right. I'm on the hook now for 200 or 300 trades that I've got to go back and prove. All right. So the solution that we offer through the account cannot be overstated, and we're doing our very best. I don't want to, I'll say a couple things about the account before we kind of get into the build. The account, we've done a lot of thought, put a lot of thought into the accounts that we put out there as solutions. And when it really comes down to, when we compare a First Trade to an M1, I think a lot of it comes down to There's a couple drastic difference. The partial share is the one that really gets people hung up, and that's fine. You have to make your decision based on what it is that you want. But really what it comes down to when choosing your account is the aesthetics. It really comes down to the aesthetics of the account. Does it offer free trades? That's a big one. All right. We offer solutions like that. M1 is like that. First Trade is like that. Merrill Edge is like that with incentive thresholds. I've got a ton of people that are in Vanguard that may not offer that solution to your guys' satisfaction. Vanguard has very, very high incentive levels in the account. It's $500,000 to get your first reduced trade. So to have the capability of trading, and I talk about passive when we start, but down the line, who's to say that you're not going to want to enter into some of these single stocks? Take profit where necessary. And you'll have the capability to do that in some of those other account solutions that we talk about. So choose wisely, okay? If you choose incorrectly, do not think that you're married to your brokerage account, okay? You're not. Switching is not a big deal. Throwing in the towel, being critical of your broker, all right? Making sure that you're satisfied with the level of customer service that you're getting. Make sure that you're happy with the level of product that they offer. And for First Trade, for me, the reason I came out with the affiliate program is because I really wanted to offer a solution to people, that of which I hadn't offered through the course of the channel. I was always just recommending large brokerage houses, the most reputable out there, and most of them charged the entry and exit fee. All right. So we were able to turn back a solution for folks to satisfy this account desire of people. And I think it really just it keeps the headaches to a minimum if you can just pick a brokerage house and stick with it forever. You guys know I'm in First Trade now. I started a margin account. I actually have a pillar of that portfolio that I have an idea for. I want that to be my small cap and international exposure. Why? It's because those are my gaps in my portfolio. Okay. So through my evaluation of my portfolio, that's the pillar that I want that First Trade account to fill for me. Now, for a lot of you guys, you've transferred over your Roth to First Trade. That's great. Some of you guys have started a brokerage house, and that's fine. All right. A lot of you folks have an employee sponsored 401k, 403b, right? You've got an employee sponsored. All right. Now, when we start to move down here to the build, all right, this is going to be the fun part. All right. A lot of you guys are starting your portfolio for the first time, okay? And maybe you're in your 20s and you haven't started that career that's given you an opportunity to enter into, you know, a Roth IRA in addition to another account, all right? So that's another thing that you want to do in this account section is identify how many different accounts that you actually have, all right? You should have a checking, you should have the savings. But do you have an employee-sponsored retirement account? Do you have your Roth IRA account? Are you married? There's another Roth IRA account, all right? And the next one after that, after all of these are satisfied, is the joint brokerage account, which is the taxable account. That's the one that you could invest some slush money into if you have a surplus over and above the maximum caps in there. That's the time when you want to go ahead and start that and start some of your pillars there. All right. Now, when we start to get into the build, this is the absolute fun part. And I want you guys to just relax a little bit and imagine that you're sitting across the dinner table, because the real nuts and bolts of financial planning takes place with a pen and a paper. Okay. It really does. I've mentioned this on my catalog of videos, and for you guys that are new and if maybe don't know what I'm alluding to, I really talk about that as being when the pen hits the paper, write down some ideas that you might have about how you take a blank pie and split that up. All right. And I really want you to consider portfolio building to just be, you've got a pie that has 100%. And all you have to really do is split that up. All right. Now, there's a few things to take into consideration. This has been an art of portfolio building and comprehensive financial planning that it's amazing to me how specific some people try to get and say you can only invest one way and this is the one right way and everything else is wrong. All right. I've done videos on this talking about how definitive talk in the stock market really just doesn't have any place. All right. Growth investing, value investing, passive investing, it all has its place. All right. But there's a few things that we have to understand that is going to affect this build right here. The first thing that we have to identify is your age. Your age is going to determine everything. And I apologize, that thing's wobbling. It's a homemade whiteboard stand, but age is the most important thing. If you guys are out there and you're looking to start and say, okay, Ryan, I understand what you're saying about the amount of exposure. I'm satisfied. I've saved up $5,000. I'm ready to go. I don't have any debt and I've got some money in the savings account. I've got a few grand. I've got $5,000 to start with. I'd like to be 75% exposed. All right. The next question that you have to answer for yourself is how old are you? Okay. And you're going to fall into any of the brackets, 20s, 30s, 40s, 50s. All right. So I don't speak in definitives, but understanding how old you are. And it's amazing how many people throw their portfolio at me and they don't tell me how old they are. Okay. They don't tell me about existing accounts either. Right? Which can really, really help formulate. Do you have existing accounts, that of which can help with our decision making on our current portfolio build? All right. Or do we not have those and we're starting from scratch, which is fine. It's totally fine. Right? We can start from scratch in the Roth IRA, but we have to know age if we know how many accounts we're working for. Now, let's just consider that for example's sake, we're talking about somebody who's 20 years old. All right. So if you're that lucky one out there, you're like, okay, I'm 20 years old. So that's a given. We know we're talking about a client that's 20 years old. All right. Now, if I was going to just bestow a risk tolerance on a 20-year-old, you should be at a 7. Okay. Why? Because you inherently have the ability to take on more risk. This is what somebody that's 50 or 60 or Greg Gatsby, who's in the group here, would tell that young 20-year-old to be like, you need to buck up and you need to suck it up and you need to get with the program a little bit, okay? And if he's not going to say it, then I'm going to say it, okay? That's not typically the case, all right? If you're a 20-year-old out there and you don't have any experience at the stock market, now, there's a ton of people on YouTube talking about and teaching about the stock market. It drives me up the wall, honestly, because over the last 10 years, it's been an easy environment to come on and teach about the stock market. This is great. You just trip and fall and make money in the stock market. This is wonderful. And you can kind of see the attitude switch on YouTube anyway, when the stock market's actually perking up a little bit of volatility and there's actually some headwind going on and not so much tailwind. They don't know what to do, all right? But if you have a long-term investing horizon, you should be able to take on a higher risk tolerance. And that's the next thing that you need to assign an arbitrary figure to. Now, the professionals are going to call it aggressive all the way down to very moderate and then conservative. Moderate to be in the middle and conservative, all right? So you're going to be conservative in the middle, moderate, and then aggressive, okay? Now, I've simplified this over the course of the channel by talking to people and having them assign themselves a value from 1 to 10. Very, very simple, okay? And instead of that 20-year-old having a risk tolerance of 7 like they should, based on the fact that they have the biggest benefit in the stock market, and that is time, I would actually start them off with a risk tolerance of a 3, okay? So we have the age, we have the risk tolerance, all right? For you guys that are new in the stock market and you're in your 30s, 40s, 50s, the exercise is the same for you guys. You have to identify where you are with your risk tolerance. I, in fact, am a 7, okay? I am a 7. That's where I am. I am not a 6. And I am not an 8. All right. I've had 25 years to sharpen my risk tolerance, and I am absolutely a 7. I understand the benefit of single stock investing. I understand my portfolio makeup with regard to my pillars. I understand the options that I have within my portfolio, and I understand the risks that exist therein. All right. I want you guys to continually evolve your risk tolerance, but you're not going to have a starting place unless you say, what type of portfolio are we willing to build as a risk tolerance 3? All right. And I want you to also acknowledge the disparity between what you should be at a 7 and what I'm assigning to you with no experience at a level 3. All right. So those are really the things that we want to kind of define. Now, the third thing that I talk about all the time that is important is goal number 3, and that is or item number 3 when you're looking to start your build is your financial goals. All right. Why are you investing? What do you want out of this? What do you want? Do you want financial security into the future? Do you want to make $1 million overnight? I've heard some crazy stuff with regard to it. Do you want to have, an additional investment account, something that can supplement your existing pension? Does this portfolio have to perform on its own, or does it need to perform in harmony with another account out there? These are some of the things that you need to talk about. Now, interesting enough, right? We've talked for about an hour here, and we haven't done any portfolio building at all, okay? It's so fundamentally important that folks understand that when we start to split up this pie, and for all intents and purposes, I'm going to split this up into thirds here, all right? We've got the stock section here, okay? We've got the ETF section here. All right. And we've got the bond section here. Let's just call it the bond section. This is what I talk about when I talk about the fixed equity over here. All right. Now, I've taken you from 100% and I just made you 33% into each one of these. Okay. Is that going to be the application that fits for the 20-year-old? Probably not. All right. As a young investor on an aggressive posture, a portfolio model will actually call for most of your investments to be in stock or ETF or a combination of both. All right. So let's just kind of talk about those options right now. If you're 20 years old, we're going to be looking a little bit more at, let's say, a 50-50 mix between stock and ETF. All right. All right. Now, these are the types of things that hit the pen and the paper when you're sitting back and you're saying, what type of investor do I want to be? All right. The difference between these two programs, the stock is the active investor, okay? And the ETF is the passive investor, all right? Now, can you do both at the same time? Yes. Does stock investing harmonize with a risk tolerance of 3? In my opinion, no. All right. Most of those 20-year-olds will say, build me a stock portfolio, Ryan. I'm ready to go. I'm ripping. And they're going to take a 20 or 30% reduction, because if you've learned anything in the stock market over the last couple months, there is no perfect stock out there. There's none. Single stock investing is actually quite aggressive. And I don't deal with crap. All right. I'm talking about investing in Home Depot at the wrong time and having it take a haircut of 30%. I'm talking about investing in Apple computers at 225 and having it adjust back into the 160s. And then you're wondering what in the heck is going on. Is that a swing that you're willing to take? I don't know. There's going to be people who tune into the Independent Investor channel, and I can't do a mental check on everybody. Some people are going to be willing to identify and understand that there's a lot more swings when you're talking about stock investing. All right. So what do we do as a solution? All right. That 20-year-old starting out in the stock market that has $5,000 to invest. Okay. The most prudent move that we can move that individual into, that I talk about all the time, is either a VTI or a VOO. All right. Now, the VTI, you could probably take and invest any amount, any starting amount in. If we wanted to take this person maybe they've saved up $5,000, let's say, and we start to build this out, I think we're okay. Now, remember the level of exposure that we talked about. We take $5,000 and put that into this pie. Is that what we want to do? I don't know. It depends on the level of exposure that you've determined in the first exercise, all right? With respect to the stock market and where it is right now, I say all the time, should we take a large lump sum of money and just throw it at the stock market? What's VTI trading for right now, guys? 136, 140, something like that. So what does 10 shares buy you? 10 shares will buy you about $1,400, okay? $1,400 in the VTI. Is $1,400 a good starting position? It could very well be, right? We're at about, let's say, 35% of our $5,000 investable capital, okay? If you actually have a risk tolerance of 3 and you have a long-term horizon to enter into the stock market, what's the harm in a 10-share position of VTI to start at $1,400? What's the problem with that? What's the problem with setting this up? Now, once this gets built, remember, this is the fun part. And if you guys can't tell, I'm getting fired up because portfolio building is just a beautiful, beautiful thing. And if we can eliminate the margin for error in a portfolio building exercise, then we're winning the battle. If I say something that you guys pick up and you're like, wow, that makes sense, that's interesting enough, it's not really about the 5,000. It's about the exposure limit that I've set for myself and trying to kind of work toward that limit, okay? Right now, this is a 35% exposure limit with regard to the other little bit that's going to be the 3,500 that's going to be sitting in the money market account while this right here is working, okay? What do I mean by working, okay? This is going to be a completely passive portfolio. It's going to be in line with our 20-year-old who has a risk tolerance of 3. We're going to go into this account, and part of the build here is not just buying this and then going like this, okay? VTI is going to work for you. VTI covers about 3,600 stocks, okay? It covers both the larger cap stocks in the S&P 500, and it also covers the small cap exposure in the total US stock market, okay? Now, is this a suitable portfolio for somebody that is 20 years old? Somebody can look at this, and this is all scratched out on paper before you buy this, and say, what is attention? You do a lot of this in portfolio building. What is this going to mean? What is this going to look like in my portfolio? What is it going to look like if I take and buy 10 shares of VTI and put that into my Roth IRA? If I'm that young person in this group right now, and I'm speaking to you, and you've got this Roth IRA funded, this is the very exercise that you need to go through and say, wow, that's interesting. I'm not interested in buying the VTI. I'm more interested in setting up a baseline exposure to a dividend ETF. Maybe we take this here and we knock this off, all right? And we end up going with a VYM, okay? And we look at a 10-share position. What's VYM trading for, guys, right now? 78 bucks a share. I think it's less than 100. I may be mixing my ETFs here, but you guys kind of get the idea, all right? But one of the comments that I've been getting on the channel is you guys are taking your portfolio and you're adding VYM and you're adding VTI and you're adding VOO, all in the same portfolio. That's why I came out with the overlap and the gaps video, okay? This portfolio right now, if I have, 5 shares of VTI and I've got 5 shares of VOO, and for a lot of you guys, if this is looking familiar, all right, and you want to own it all, okay? These are all quality products. The problem is there's a little bit of cannibalism going on inside of this portfolio, and this is what I consider severe overlap, all right? Now, minor overlap in the portfolio is going to look like this. If I had a VOO, for example, in this portfolio, and then I had 10 shares of VOO, and I have 10 shares of Apple, computer, okay? 10 shares, all right? That is minor overlap in my opinion. Now, the latter is more acceptable in my particular opinion, all right? But remember when I talked about the risk tolerance of 3, all right? Is this individual going to be able to deal with the volatility up here and the swings in single stock allocation? Because if we had entered into Apple at the wrong time, I was recommending to buy Apple at 220. I'm recommending to buy it here at 160. I just did it this week. I picked up 30 shares of Apple. But does that individual in their 20s have the ability to work through those swings and have a portfolio like this? This is really for you guys to answer on your own. But here's the thing. There's minor overlap in this portfolio, and there's gaps that exist because VOO, remember what I said, only covers, this is 81%, okay, 81%. So the gap in this particular portfolio is the 19% of small caps, okay? So that right there is kind of the roots of portfolio building for a 20-year-old, okay? Now, we're building this portfolio in reference to the risk tolerance that was declared and the time horizon that we have. Now, portfolio building does not stop and end with the initial 0 to X amount of dollars. What I mean by that is if we're going to enter into this portfolio, let's say we take the same example with $5,000. We're going to put $2,500 to work in the portfolio. Let's say we get a 10 or a 20% downturn next year, all right? We've got the ability through identification of our gaps in the portfolio. We know that if we have 10 shares of VOO, again, 10 shares VOO, that's going to be 2,500, okay? And this is just assuming that you take and invest 10 shares, okay? You can have 2,500. A lot of you guys are going to want to fully expose, right, based on the amount of savings that you've got built up, okay? You could justify taking the entire $5,000 and putting it to work in a passive nature in this portfolio, all right? But I'm just throwing out the examples rapid fire. So some of these may hit home for you and others may not, all right? But this is the whole idea behind this $2,500 idea here in VOO. Now, this is year 1, okay? We have such a long time horizon down the line. Let's say sometime throughout the year, we're setting ourselves up. And I say this all the time, and this is a critical takeaway. This is the mentality that I take when I'm looking to execute the build in a portfolio. Is this portfolio subject to a downturn? Okay. Is it able to enjoy appreciation going forward? Sure it is. If the stock market continues to go up over the next 2 years, is this portfolio going to grow? Yes. If the stock market gets extremely violent next year, is it going to be able to withstand a downturn in this portfolio? Yes, it will. All right. You're diversified across this base. The VOO pays a dividend of about 2%. You're going to make those dividends through the downturn. You're going to have a little bit of cash on the sideline, maybe to strategic buy that. Maybe you just let those shares work. But what you're doing is you're allowing yourself the opportunity to make decisions based on the decisions that you made at inception. All right. Going from 0 at inception to something, there's the most potential for mistakes during that inception to something phase. All right. Portfolio building becomes a little bit easier over time as long as the decisions that you made are strong decisions. And that's why we don't shy away from recommending products like this, because this is a strong decision. Okay. And I know a lot of people tune into YouTube and they want that perfect recommendation in way of stock. All right. And they typically end up getting a stock that has appreciated for someone and they're buying it at the wrong time. Okay. That really is. So this right here is really the passive entry to the stock market. And I throw out the $10,000 idea to take one of these very, very good ETF products. And I use ETF and index fund somewhat interchangeable, all right? I know JL Collins, he recommends, I think it's the VFIAX, I believe, which is the VTI. I could be wrong on that. If you guys know the actual ticker symbol, you can throw it into the community. But if you want to go with an index fund, that's totally fine. I see no difference whatsoever in the two programs at all. It just comes down to preference, whether or not you want your shares to settle after the market closes or to have the stock react like an ETF does. An ETF is going to trade during the day, and that's really all I can identify as far as a difference between the two very low-cost products, two very, very good products. But this is really the passive option. Now, what if we have the 45-year-old? 45-year-old wants to come enter into the stock market. The only difference between the 45-year-old is that 45-year-old has a $75,000, 75K in a 401k, okay? And I throw these examples out there because when we're talking about the build, everybody has their own unique situation, all right? And if nothing else, watching the Independent Investor channel, if there's nothing else, I talk about empower, okay? I can't sit here and perceive to know what your situation is unless you throw it my way. And I do the very best I can at responding to your situation. And I'm going to tell you, the majority of the time people hit me up with their situation is I don't get the full picture, okay? I don't really know where you are with your debt situation. I don't know where you are with your, let's say, home equity, if you have any, your employer-sponsored 401ks. And that's why I say all the time, the benefit of the Independent Investor channel is such that you can kind of take and do those self-assessments yourself. And I know a lot of people would say, geez Louise, I need help with this stuff. I just don't think that you do. You can really take and earmark those things, split them up in your mind. And if you've done that beforehand, it's going to give you that much more of an opportunity to build this portfolio to be the most beneficial to you over time. All right. Now, 401k at 75,000. So somebody's going to come to me and say, I've already got this passive base. I'd like to enter into more of an active portfolio. Okay. My risk tolerance is, let's say, a 5. Okay. So unlike the 20-year-old who thought they were a 7, and I've actually deemed them a 3, this person is actually taking a more realistic approach and saying, look, I'm 45. Wealth preservation is kind of a key for me. You know, my 401ks are very much built passively. I do get matching in that. You know, 75,000 is what I've got in there. I've only worked for the company for, let's say, 15 years. All right. This is a very realistic scenario. So when we look at this portfolio build, I always look at portfolio building as you look at the totality of options and then start shaving it down. You never, ever want to look at somebody's situation and say, you have to do this. That's what I don't like about portfolio models, is because people take it and they're like, I have to do it this way. Not really. You can use it as a recommended guideline. But honestly, when I talked about the 3 options that you have, the only thing that you need to do is adjust your 33 1/3 in that pie to be conducive to what you want out of the stock market. All right. So 75K. And then we've got a portfolio here. You're 45 years old. You have a risk tolerance of a 5, let's say. All right. And I want to build, let's say, a dividend portfolio. All right. So I want you guys to think about the build as splitting up the pie. All right. And that's a very, very key takeaway. All right. So if we're looking at this section here, all right, this would be the stock section. Okay. And in this particular example, we're going to go ahead and do some ETF exposure as well. Okay. And over here, we're going to actually start some fixed. Okay. Now I don't have these drawn to scale, but I do this for a reason. I started at 33 1/3 just to get your mind wrapped around the fact that we don't have 2,000 options, okay? We don't. We have 3, all right? And that's just the way my mind works, all right? You're going to say, well, hold on, Ryan. There's, 508 companies in the S&P 500 that we can choose from. Yeah, but think about it in a strategic way, okay? You're going to get confused out of your mind if you look at a listing or a heat map of the S&P 500 and you're trying to throw darts at a dartboard as to what you want out of your stock section, all right? We'll get to it, right? There's a strategic reason why I come out with the videos that I do. And the sector spider allocation here, that's this section down here. There's 2 different ways to meet this ETF threshold here. Either by buying the sectors or buying the market, okay? There's 2 different ways. There's no other 2 ways of doing it, all right? You can gain your international exposure here in the ETF section. You can gain your emerging markets in that section, all right? You can gain your exposure through holistic markets. You can do that. Now, remember what we said over here with the 401k. We've already got 75,000 in the 401k. So let me ask you this. Does it create an overlap when we're looking at the ETF section to buy a VOO in this particular section? Does it create overlap? I believe that it does, okay? I've looked at a lot of 401ks that are offered by Vanguard, Fidelity, etc. You're getting free money over here in a lot of cases through the company match, all right? So why does this matter over here when we're looking to build this portfolio, all right? It's because I always ask this as well. Do you have any other accounts? How much cash savings do you have? Why do I ask those questions? It's not because I'm curious, okay? It's because I need that information. You need that information to make sound decisions over here. And it actually gives you more options. It gives you the freedom to say, look, we've already covered the baseline in the stock market. I'm happy with the performance of my 401k. It slowly grows over time. I just fund the hell out of it, right? And it works for me. How is it that I can strategically build my portfolio to be a little bit more cutting edge, for a lack of better terms, because I've already got some of this stuff over here met. All right. So now we look at this ETF thing and we start to eliminate some of the options that we have. I would say that a VTI for this 45-year-old maybe doesn't make as much sense because we've already got this over here. Now, what happens if we erase this and we don't have that 401k? Okay. Remember this, and does this portfolio have the ability to stand on its own, right? How is it that we would adjust our 33 1/3 here in this portfolio to make more sense if we don't have this strategic start here? All right. Let's say somebody comes to me and says, Ryan, I was stupid. I should have invested when I was younger. I want to invest now. What is it that I do? I don't have a squat worth of savings. I have a 401k with $2,000, not $75,000. How can I start my portfolio now, right? To invest in the stock market correctly. Now this 33 1/3 right here becomes extremely important, and we do not have the ability to discount the importance of the VTI, right? We want to enter into passive ETFs first. Doesn't matter if you're 45 years old or it doesn't matter if you're 20. All right. I'm not going to put you into a stock portfolio when you're 45 years old because you haven't spent the time investing over the course of your life. No problem. No problem. It just means that this ETF section here has to be looked at a little bit more strategically. All right. Now, for the sake of example, let's get back to this 75,000 in the 401k. And I'm like, yes, that's great. That gives me a little bit more opportunity here with the ETFs. Does the 75,000 in the 401k mean that we could potentially introduce a certain percentage of fixed within this portfolio? I would say yes. All right. This is the very situation that I personally was faced with here. I'm 41 years old. I'm an aggressive investor, or at least modestly or moderately aggressive. Okay. So I'm either aggressive or right below that tier. Okay. And when I looked at my portfolio, I really wanted to have some fixed equity exposure. Right now, I wrote that fixed equity exposure into my portfolio at a 10% clip. All right. So we adjusted back from a third in the portfolio to about 10% exposure in my portfolio. That's me personally. All right. Now, an individual that's 45 years old that has the ability to step some money into a Roth IRA, if they're starting from scratch, all right, they're going to have to be able to step that money in at $6,000 a clip starting next year. All right. So we have to try to grab as much stock market as we possibly can. So does the fixed ETF make sense for somebody at 45 if they don't have any money in a Roth IRA? I would say no. Okay. So we do away with this. All right. Now, you may come back and say, you're wrong, Ryan. You should add that into the portfolio. But I would look at it as an acceptable gap in this portfolio, that of which I could add a little bit later after I've put some of those good stocks and good ETFs to work. I don't fear stock and I don't fear ETF. Remember, I'm dealing with somebody who's already invested in the stock market. So I should have somebody that can deal with a little bit more of a portfolio allocation that makes sense for them. So at 45 years old, does the $75,000 allow me to step into the stock market a little bit more aggressively for this person that would make sense? You want to know what makes sense to me? And guys, remember what I said about not being a right or wrong answer? For this individual right here, this is what makes sense. Okay, let's see if I can draw this pie correctly here. ETF here. Excuse see, I told you I'd screw up the drawing. And the rest of it is going to be stock. Why? Why did I do that? It would really depend on what the holdings are in the 75,000 with the 401k, how I would look at allocating this ETF section of this portfolio. I may take a hard look at the 401k and say, look, that it's minus some small cap exposure, or it's minus some international exposure, or potentially the investor comes back and says, listen, I'm really interested in healthcare. Can we invest in some healthcare stuff? I'd maybe like to add a spider ETF here to get some real focused attention on that particular piece, right? Because we've got the holistic market over here. How can we go ahead and benefit the most from this ETF section over here? And this is going to be my 70% split. It's going to be a 70-30 portfolio, right? So 70% here and 30% here. Now, remember, we're always setting ourselves up when we're splitting up a portfolio to be built upon later in life, okay? So it may make perfect sense for somebody that's 45 to take a low cost, let's say small cap exposure here. Let's say over here, they've done nothing but invest in value over time and they're void some small cap exposure. We could take some of this ETF here and put this into small cap exposure. So this is done, right? We build it out. We've got VB here, okay? So we put VB in this side of the house. Then I come back and I say, okay, we want to sharpen the spear. All right. We want to add some single stock over here to this side of the portfolio. We're going to put 70% of our money in some starting positions. And so many people hit me up and they're like, okay, I got free trades. This is a very first entry. We've got $6,000 in this portfolio. How many stocks are realistically going to be purchased with $6,000? You guys probably have an answer in your mind, maybe 2 or 3. I would say anywhere between 2 and 4. You could probably start some positions in some stock, that of which you can make decisions later on that are predicated upon the decisions that you make now. All right. Where do we pull these portfolio solutions from here? Where do we pull this from? Remember, think about why I'm going through the strategic exercise here. I've got a $75,000 base here, all right? I've got a supplementary 30% ETF here with VB, the small cap exposure, and then I'm looking to get a stock portfolio here built that's going to grow over time, maybe they look at the decision at 59.5 to look at this portfolio and say, wow, I just want to keep it riding. That's performed well. Using the rule of 72, how many years do we have before this portfolio doubles or doubles again, right? If we've got 15 years, right, at, you know, we could get 10% out of this. We could have a couple doubling cycles in this, right? So if you paid attention to the rule of 72 video, this could kind of make sense to you here. This is the beauty of it. And this is why I've said all the time on the Independent Investor channel that this is the easy part. Picking stock solutions in a portfolio is freaking fun. I just did it for somebody tonight. It took me about 32 seconds. They can attest to this. I want to build a stock portfolio. It made perfect sense. Perfect sense. And I'm not going to use names, but I will use exact figures. They did not have 75,000 in their 401k. They had 325,000. Okay. They had not a zero starting position for a Roth IRA. They had 38,000. It's the exact same approach. All right. Now, does the $38,000 Roth IRA portfolio and the $325,000 start over here make sense for somebody that's younger than the 45-year-old? Could we do away with this section here? Yeah, you bet we can. That's where we start to get here with a stock portfolio that's 100%, okay? Stock portfolio 100% here. Why does that make sense? It's because the small cap exposure that I was going to add to this portfolio already existed in the $325,000 government-sponsored program that individual had, right? So very, very important to understand that the two will reflect each other, all right? Now, in this example, this individual had zero exposure to single stock, all right? I think they had a few positions in a brokerage house, but what they wanted to do was build their Roth portfolio to really be the tip of their investing portfolio or their holistic makeup, all right? Didn't have any fixed equities positions. They didn't want it. Does it mean that they're wrong? No, right? We do not talk about portfolio building as being an option limiter. We talk about portfolio building as being an options identifier. Very, very important. So when we take 100% stock portfolio, and this is one of my favorite to build, is we look at the stock and we look at that section of the portfolio and we do this right here. We do we're good. We do 75% divs, and we do 25 growth. So the question in this portfolio becomes, when does it become okay to buy Facebook? When does it become okay to buy Amazon? When does it become okay to buy Netflix? I can keep going and going and going and going, right? And so many people hit me up all the time, and it's the $1,000 person that's 20 years old with a risk tolerance asking me if I should buy NVIDIA. The answer is no, right? That is the real key essence of Portfolio Building 101. And I'm going to get to some of the questions before I get to some of my more examples. But I've went through this for an hour and a half. And this is just part of the exercise that I go through in dividing up the pie. And it's a very, very complex solution, right? It's a very, very complex topic. And the reason why it's complex, it can be very, very easy. But the very bottom line as to why this is so complex for people is that everybody's situation is different. And that is why I always say every portfolio is different. A portfolio has to reflect who you are as a person, what your age is, your tolerance, and your goals going forward. No portfolio has to be the same. And that's my problem with videos that are how to invest $1,000. And they cookie cutter you into a program, and it doesn't have anything to do with who you are. What if you're a 20-year-old and you're making $250,000 a year? Does it make sense to take a portfolio at that particular juncture and change it into 100% growth? Why not? Why not? You're making the income. It could make perfect sense for you to take on that extra risk. If you come back and that 20-year-old says, look, my mom and dad entered into the stock market when they were young, and now they're multi-millionaires, all right? I have a risk tolerance and an understanding about the stock market not indicative of most 20-year-olds. What can you do for me? What is my solution? Could it make sense? Would that person have about the same risk tolerance as me? You bet. You bet. So it makes sense to take those folks and introduce them maybe to 100% growth portfolio. But it has to be predicated upon answering those few questions to start. What is your exposure? What is the right account to work this business in? And then to get down into the nuts and bolts of the builds. So guys, I'm going to jump right in back to the community again. I apologize. I really had to focus on delivering the portfolio message to you guys. But I really want to make sure that if there's some other questions here in the group that I've got to them. Typically, I get to the end of this live stream and it dumps a bunch of questions on me. So I'm back in the group now paying attention here. So I'm sorry, guys. I'm such a noob. So that's something else, man. I threw at the top of the group here, and I can hopefully help you guys with some of the questions for the last half hour, I guess, of this live stream. But no question is a dumb question, man. There's probably a ton of people out there that are asking the same exact thing. But I think just working through this exercise, you're not going to understand portfolio building the first night you hear it. But man, I tell you what, I just laid a ton of stuff on you guys, a ton, all right? And hopefully you picked up on a little bit here and there. If you need questions of clarity, we're going to continue to work your guys' individual programs. Like I said, that of which I cannot understand specifics about. I've got 10,000 people in the community, and I have a very, very astute group. There are firefighters, there are teachers, there are federal law enforcement officials in my group. These are very, very specific individuals that need solutions to their plan. And hopefully by coming out with videos like this, we can kind of help bridge the gap between you guys identifying your own situations. Nobody's going to be better at identifying where in fact you are, what your financial stewardship is, what your financial health looks like. What are some of the areas you need to work through to get to your ability, like this individual that I spoke with just today, who said, I want this. I want 25% growth in my portfolio. I want dividend portfolio at 75% clip. And that's exactly what we did for this individual, man. We built it out, piece of cake. Why? Because they were eligible to do so. All right, that's why we did it. The solution made sense to those folks, right? I'm 41, no investor experience, and downloaded M1. What do I now as far as a pie? Yeah, so there's a ton of folks in the group here that actually use M1. I used it for about a month, and I've moved away from M1, but Brent is in the group here, I believe, or I saw his thumbnail pop in here as well with the financial investor channel. He's in here somewhere, but there are model portfolios inside of M1 that are really, really helpful. And they're going to talk about some of this stuff. Let's say, and what I talked about, this is the type of question I get all the time. So I'm talking about the Mr. Finance Guru, 41, no investing experience. You're not the only one, okay? You're not, and that's fine. I would rather take somebody who's 41 and willing to learn and enter into the stock market correctly than deal with somebody who knows it all and just wants to invest the way they want to invest and doesn't want to listen to anybody. But I'd rather get you started. If you're working and you're eligible to contribute to a Roth IRA, that's certainly a start. Identify for yourself what type of spending capital that you have to invest in the stock market. And those two things are really just a nice start for you. But within the M1 platform, there are model portfolios for you to look at within that platform that are going to help you understand in some form or fashion the exact same thing that I looked at here. And if you were 41 years old and you were looking to enter into the stock market for the first time, I would start by building that base. That's what I would start with. Get those positions either in the total stock market index started, enter into those and build them up over time. You need to prove to yourself that you can become an investor, because if I'm understanding, I'm a realtor and investor in properties. This is a totally different world. Hey, fantastic. Not really. Real estate is actually one of the few appreciating assets. Vintage cars and art are the other ones, and I know a squat about those. Precious metals is the other one. But if you're a realtor and a real estate investor, this fits right into your wheelhouse, honestly. If you've got the ability to generate some cash with your investments and your, maybe some rental incomes, or you're pulling down some big capital on some of the deals that you're making, you really should have something started here, and we can really help you dive into some of these solutions and building a portfolio for yourself. FI, if you're still here, I subscribe to your channel. That's what I like to see, man. I like to see the support. Brent's really good people, and he's an active investor in M1. I'm an active investor in First Trade and Merrill Edge, as you guys know. So, there's a lot there to be had. And I basically told everybody, if they didn't have any experience, to come into the group here and just nobody's doing this on YouTube. Nobody. I got accused of being greedy 2 days ago by one of the subscribers on one of the live feeds. And you guys have to understand, I talk until I'm blue in the face. I mean, I lose my voice and I can't talk anymore. And I was accused of being greedy because I put too many ads in the live feed. Actually, I didn't. YouTube automatically put it in there because I don't think there's very many who come on to YouTube for 2 hours and do an unscripted talk about Portfolio Building 101. And I don't think YouTube knows how to even handle a channel like mine. So they put 8 ads inside of my my live stream, and I was accused of being greedy. And just kind of a side note, it's really one of those things, kind of unfortunate, because if you just come in here and you open your mind a little bit, you'll understand a little bit more about your own situation and what you need to kind of focus on to help yourself. So, Ryan, are you changing Vanguard sector ETF percentages as you age, or will they stay at percentages you mentioned? They will change over time, but the change is very, very simple. You'll go from lesser of a stock portfolio when you get older, as opposed to the 20-year-old. So let's just take a 20-year-old and a 55-year-old. When you get into your 50s, you're probably going to have a pretty good amount in your fixed equities because you're looking more to preserve wealth than you are to grow wealth in your 50s. And it needs to be very, very crystal clear on how long you're going to work for and when you actually need the money down the line. Okay, not necessarily when you retire, but when you need the money. A lot of people aren't going to need the money at 59 and a half. They may be looking to retire at 70 or 67, or looking to have a little bit of supplement or gap between the time that they retire and the time that they draw on their Social Security. All right. An investment account is just going to be your opportunity to bridge that account for living expenses before the time that you actually can draw Social Security, if it's in fact there. So yes, those percentages will change over time. They really will. And that's really what it comes down to, is lesser of a stock exposure. And I think a lot of the goal behind getting folks into the stock market and exposed correctly and building wealth over time is to, again, put yourselves in that decision down the line. If you're sitting on $750,000, $800,000, $1 million in your account, for me, the ultimate goal is going to be to de-lever some of that risk from the stock market. And a Roth IRA is going to allow me to do that at 62 years old, or right after I'm 59 and a half. I will evaluate the stock market. I will look at whether or not it's a good time. And I may be looking to start an account of FDIC insured savings accounts with $250,000 in each ones. That's about the safest form of cash that you can possibly have, is up to $250,000 in an FDIC insured and not tethered to the stock market. All right. If you guys want to continue to keep your money riding into the sunset in the stock market, you're welcome to do so. But you know, I'm not married to the stock market. I'm looking to use, abuse, and take everything I possibly can from the stock market, use it for what it's intended for, and then get the hell out. All right. I don't have an emotional connection to the stock market, not whatsoever. I'm doing it for capital appreciation now. It will be capital preservation later on down the line. And then ultimately it will be, you know, a capital saving. That's it. And that's what I'm using it for. So yeah, that's exactly what you're looking to do, man. But it's really good to see you in the group here. I hope I've kind of hit home with a lot of you guys, man. I can hardly see. I'm seeing double right now, providing this opportunity for you guys to come in and get Portfolio Building 101. But I can tell you one thing, I'm definitely not greedy. That was really out of the blue. I have no idea what that individual was talking about. And I told him to unsubscribe from the channel because I don't want that crap on the channel. So good riddance to him. And I wish him all the luck in the world. I really do. Because people like that tend to just miss the message altogether. Becky, it's hard to transfer Roth to an M1. It's not hard. Just takes a phone call. Anytime you guys are transferring, you guys, I get the sense that it's like life and death transferring from a brokerage house to another. It's very simple. You guys are going to have to get used to talking to customer service, letting them know, hey, I want to do this. You don't have to tell them why. It's your money. You can do whatever you want. All right. So transferring a Roth IRA into M1 is actually very simple. It's called a rollover. All right. Those accounts can be transferred in kind, or they can be liquidated and transferred, whatever's easiest for you guys. Sometimes the easiest way to do it is just to transfer it in kind if that's what you guys want to do. And that option exists there. I do want to get back to the community and make sure that I'm hitting all these questions here, guys. So I can build my dream team and then transfer the funds to it. You could do that if you wanted. I wouldn't recommend that. I'd recommend you actually picking the account first and then building the account that you want within that. It's just going to make it a whole lot easier. All right. It is easy, but it's a pain in the rear too. All right. But you guys don't need to fear that. I got hit with a question. Do I need to be with my broker for a certain amount of time before I transfer out? No, it's your money. All right. You can do whatever you want when you want. You're a self-directed investor and you got to start to think like it. Okay. Use the brokerage house for what they're there for. And that's to provide a service to you free of charge. Why? Because that's the environment we live in now. If they don't like it, you can transfer to the next one down the road and get all your free services from them as well. That's why we recommend the solutions that we do. It's honestly not worth putting up with Vanguard's high fee restrictions in the account when you have other options that give you the exact same exposure to the stock market free of charge, right? So that's why I mentioned that account caveat before we're looking to enter into the building stage of the portfolio. Becky, it's not hard. I just did it. That's true. Thank you for that. I mean, it's just a testimonial to kind of back up what I'm saying there. Don't want you guys ever to shy away from it. There's something you don't like about a brokerage, don't hesitate to swap. It's very, very simple. It's very, very normal. All right. You're not tethered to your broker. You don't have any type of loyalty whatsoever. So let me scroll back up here, guys. Make sure I hit everything here. I'm going to scroll back up. You could start with VOO, VB, VXUS, Apple, PG, J&J, Facebook, GIS, MPU. So Hector Mendoza is actually throwing the, I would want to compare VXUS and make sure that there's no overlap in the VXUS and VOO. But I do agree with supplementing VOO with VB. So thank you for offering that idea. And then, of course, I talked about the acceptable levels of overlap. The reason why those overlaps of owning the VOO and Apple at the same time is because, geez Louise, man, Apple has done nothing but pay stockholders back over the long term. The VOO really is just your barometer of the stock market. It's to make sure that you're participating in the entire market, all the goods and all the bads. But when you enter into single stock investing, it's a ride. It really is. But I think if you look historically over time, you know, those dividends that you get paid in that are well worth it. There's no better single path to wealth in the stock market than through single stock ownership. And I mean that wholeheartedly. But I hesitate to say stuff like that because I know a young investor is going to be like, yep, I heard what Ryan said. I heard what he said about starting a baseline, but I don't want to do any of that. I just want to enter into single stock. You can do that. Just make sure that you heed my warning. You need to make sure that you actually do have that risk tolerance of a 7 as opposed to a real risk tolerance of a 3 because you haven't went through, the evolution of understanding what it's like to live through a recession. And you may get your chance here within the next couple of years. So buckle your seatbelt. We're in for definitely a ride. It's going to be interesting. And I could be completely wrong, and the stock market could continue up for the next 4 or 5 years. I don't know. And that's the most prudent advice that I can actually give you by saying I don't know. All right. You need to hear that, and you need to hear it over and over again because nobody really does. All right. I'm going to scroll up and make sure that I got everybody, man. It's not hard for me. Okay. Guys, if there's any more questions out there, man, throw them in the group. I am going to sign off here fairly quick. I appreciate you joining in on this Sunday live stream. For anybody that joined in on this group here, hopefully you got a great explanation of how I go about breaking down a portfolio. Depends on how much money you have in the bank. You guys are conversing with each other here. Guys, it looks like I kind of got to everybody. You guys had a great discussion while I was droning on for an hour about portfolio building. If you have made your way in the group and you haven't hit the thumbs up button, I would just kindly remind you that I certainly do this for you guys. It has nothing to do with my greed to make insurmountable money on YouTube. I'm still waiting for that day. I'm not really sure. I know there's a ton of people on YouTube who are making more than doctors. I am not one of them. So certainly if you can hit the thumbs up button for me and you appreciated the message, man, I really appreciate it. Suze made it to the live session. So for another name I hadn't seen there. VTI and VTSAX are identical. Correct. That's awesome. That's the VTSAX is the one that JL Collins recommends. And ironically enough, me and him were on the same page, and that I recommended the VTI on the program, and that was the exact same identical. That's part of my most popular video when I came out with that is the best ETF, best index funds on the market. That's my most popular video so far. I've got 16,000 views on it. That's my biggest one so far. So, so Brent, hey, thank you so much again for stopping in this evening on a Sunday, man. I'm not going to typically do this. I have a poll going on amongst the community asking when the best, the best day is to do live streaming. It's looked like Sunday might be kind of winning a little bit. We'll see how that shakes out. But Fridays are more convenient for me as I do actually work a real job because again, I'm not making insurmountable money enough to where I can go buy a Ferrari on YouTube. So we'll see what happens there. But is this a pre-recorded live? No, this is actually live. Thanks, Dave, for clarifying that. Guys, it doesn't look like I've got a whole lot here. Ryan, if someone is a low man on the totem pole, blue collar position, working for a top rated blue chip company that offers stock plan with a discount, what is the maximum percentage of pie to allocate? I would just say that would fall into part of the pie. I've got one of the folks in the community that actually does that with Home Depot, for example. And it's a stock sharing type of opportunity. And since they're being offered that stock incentive with the company, you basically just roll that in with your holistic look, right? So you really wouldn't need to supplement Home Depot with any more Home Depot shares. You may shy away from the discretionary ETF portion of the portfolio. It's just a small piece in the greater good of owning those shares with your company. And I would take that into consideration when you're building your portfolio out. I don't think it's a huge piece. I don't, depending on how much money you're talking about there. I've had one subscriber hit me up and say that they've got 500 grand in their company stock. And it's just like, geez Louise, that's an entire portfolio for most of the folks that I talk to. in the group, but that's a pretty awesome question. Yeah, thank you, Ernest. He hit me up and gave me the actual VYM. I thought it was around $80 a share. So, guys, I will be signing off now. For the folks that review this and revisit it after the fact, I really could have spoke for much more in depth on portfolio building, and that's really the best way of doing it, is to offer certain examples and just kind of cross compare and say, hey, what would work in this portfolio? What may potentially not work, and what kind of fits. And it's just all about adjusting that 33 1/3% or eliminating one of the thirds altogether based on other assets that exist outside of that portfolio to build a portfolio that makes sense for anybody out there. There's a solution for anybody, all right? And the idea being is that you're not going to enjoy a live stream for a couple hours and come out with all the answers. But hopefully we've been able to open your eyes a little bit on what the options are out there. And if some of those options don't fit for you, that's okay. The idea is to gravitate toward those options that work for you and to find that perfect fit for your portfolio. And if you have questions on it, hit me up directly. We'll look to evolve your portfolio over time, guys. With that, I will sign off this evening. Thank you so much for tuning in to this Sunday live feed. Very successful for me, man. I had to offer this to the group. There was a lot of confusion about, what ETFs to use, what can you use together, and hopefully this video kind of clarified what it is you're looking at for solutions within the portfolio. Guys, thank you so much. I appreciate it. Enjoy your week, and I will see you Friday for the normally scheduled Friday live stream. Thanks again, guys, and I will sign off with that. Thank you.